Hello and welcome to this Livewire thematic discussion. It's the start of the year in 2017 and I have two fund managers that delivered some great results in 2016 here to help us discuss how we're going to make money in 2017. I'm joined by Ben Rundle from NAOS Asset Management and Chris Stott, who's CIO at Wilson Asset Management. Gentlemen, thanks very much for your time.
Thank you.
Thank you.
Chris, I'll start with you. The backdrop in 2017 is really being dominated by discussion out of the US with the new president. He's had a busy first week. Domestically here in Australia, we're gearing up for reporting season. A few downgrades coming through, particularly in the small cap space. Just in terms of the investment backdrop, how are you sort of spending your time thinking about this big picture backdrop versus what's happening locally, and how are you separating the two issues, or are they related?
No, look, they're definitely related. We typically are just fundamental bottom-up stock pickers, so but you no doubt have to factor in the macro as a large cap investor, to a less extent as a small cap investor. So that certainly is grabbing a lot of the headlines at the moment, and will continue to do so with Trump's, general controversial nature, and that won't stop as we go forward from here. But certainly, the picture looks okay for us in terms of the Australian market. Interest rates, we think, the next move will be up in perhaps later this calendar year or early 2018 in response to stronger inflation, stronger GDP growth figures that come through, particularly from the resources side of the economy, and the housing market still remains quite strong. So I think the doomsdays will be wrong on housing. I still think low interest rates, low unemployment, the petrol price is low. The consumer feels okay at the moment. So some of those discretionary retailers look okay too for us at the moment. So certainly, but PEs are certainly elevated in the industrial side of the market. So we'll make the old cliche, it's a stock picker's market.
Okay. Ben, we've seen the Trump rally has really got some traction. It's had a good, strong 3 months. Do you think that the traction that it's got is justified? Is there enough data and momentum in the economy to suggest that things have turned a corner?
Yeah, look, to some extent I think it's justified. I think Chris hit the nail on the head. It's very much a stock picker's market, and it's hard to try and trade off the macro, given we just don't know what he's going to do. Now, if you take that view, then maybe you've got some gold in your portfolio, as a hedge against any fear or any sort of erratic moves that take place. But if you look back here to Australia, things do actually look okay. The numbers, the economic numbers are all right. There are some parts of the economy that will struggle. So, the Aussie dollar's held up pretty well, for example. That'll hurt some industries. We have seen inflation easing a little bit. So, I don't think the consumer is going to be hugely strong. But, there are some sectors that are doing well. If you look to the resources, for example, we've had such a strong move in the underlying commodity prices, and it's taken a while for the analysts to upgrade those. So we've seen a huge EPS revision upwards for the whole market coming into reporting season. Now, I think a lot of that is the resources businesses, and I think that is justified. And I think that in that environment, you're a commodity company trying to push out as much volume as you can at a high price, and that'll pay off. So even companies that have a huge amount of debt will be able to create enough cash flow to pay that down quite quickly.
The story of the resources companies has definitely captured people's attention. I guess the question is, is it a long-term, is it going to see a long-term kick along? How do you think about that when you see stock prices that have rallied dramatically, commodity prices are higher, dramatically higher than where they were? Do you want to step into that space, or are you now cautious on resources due to the price increases we've seen?
Typically at WAM, we're generally investing in industrial companies, but to a lesser extent resource companies, and certainly us, along with a lot of others, over the last 12 months missed the rally in resources, and that has hurt a lot of domestic fund managers' performance in particular. But as you look forward from here, I think the easy money's been made in resources. BHP at $26. People will be looking for capital management, which is typically an early to mid-cycle phenomenon. And I think we will see a lot more secondary capital raisings from a lot of these resource companies that have had good runs, in particular over the last 3 to 6 months. So certainly, we're staying away from the resources space at the moment. We think the easy money's been made, but certainly if commodity prices hold up, as Ben said, certainly that could be one of the stronger sectors as you go through into this reporting season, with earnings per share growth starting to come through in a large way for some of these companies.
Well, moving from the strong to the weak, we've seen the small cap and mid cap growth sector has been littered with some quite painful downgrades. Are we being told to stay away from this sector? Is that what the message is? Are they particularly susceptible to downgrades at this part of the cycle?
We still think that the rotation that commenced around 5 or 6 months ago out of small caps into large caps will continue, and we think that the large caps could potentially lead the market over the rest of 2017. But certainly the PE contraction, which we are seeing, we are in the middle of that now, we think will continue with bond yields backing up and interest rates generally globally as a whole going up over the next decade. So certainly a lot of these high PE names, and we look at things like WiseTech and Domino's, Technology One, which are great companies, but everything's got a price, and so those three in particular look quite expensive to us. So it'll be quite interesting to see in this reporting season coming up now how these companies that may put out good results, how the market will treat them on these lofty multiples.
Okay. Talking about reporting season, often the reports are judged on expectations and how they deliver against those expectations. What's your sense of how the market is priced, and what the expectation is going into reporting season?
Yeah, I mean, to Chris's point on small caps, they were obviously the only place in the market where you could get growth last year, and because of that became a very, very popular trade, and they trade on huge multiples. And so any hint of disappointment, we're seeing catastrophic sell-offs, in the order of 20, 30, 40%. But if you really look ahead this year in terms of what's going to drive the market, I agree. I think the move to large caps, that sort of has taken place, and I think that large caps will continue to outperform. And look at the biggest companies on the market, the banks. Not only are they showing pricing power at the moment by adjusting rates higher out of cycle, I actually think that, and I think Chris agrees with this, that we will move into an interest rate upgrade cycle throughout the course of this year, and that's positive for banks, and you'll start to see that really affect returns and drive their share prices, which will help drive the wider market.
Chris, you put out a note earlier this week saying you felt the yield trade had run its course and was going to continue unwind. Which stocks do you put into that basket, and how long is it going to take for these things to roll off?
Well, it could take a while, but Transurban and Sydney Airports are two that really stand out to us in that particular bucket. But certainly this chase for yield that we've seen, and understandably so, and we've seen it with our business with the rise of the self-managed super fund and chasing that fully franked yield, and that we think that will continue. But as Ben was talking about earlier, with interest rates starting to move higher over the next 3 to 5 years, the interesting thing will be, particularly all these retail shareholders that have been looking to the banks and some of these bond proxies for yield in the last 4 to 5 years. In particular, when they start seeing being offered term deposit rates getting closer to 3, 4, even 5% over the next 3 to 5 years, that marginal investor may switch out of equities and go back into cash, and that's something that we'll be watching very, very closely. But so certainly we think that a lot of those bond proxies, as you deem them, look expensive on a fundamental basis, and we really struggle to see any value in that particular space at the moment.
Okay, we've talked about a few areas to avoid. You've got a few areas where you're doing some happy hunting at the moment that you can share with us.
Look, one stock we think that will report quite well next month is Nick Scali. Furniture retailer, still under-owned, we think relatively undiscovered by fund managers on a P of 13, we think growing at 20 to 25% over the next 1 to 2 years. The macro backdrop for Nick Scali is perfect at the moment, where you've got low interest rates, low unemployment. Sydney and Melbourne are really firing on all cylinders, particularly Sydney, and we think that will really drive Nick Scali's earnings per share growth over the next 1 to 2 years with an under-geared balance sheet net cash. And
the property cycle strong enough to support that?
Look, we think so. Look, we think that residential property has still got many more years to run. Interest rates are generally, as a whole, are going to remain quite low for a long time still yet, even though they are going to be moving up. So certainly you will not see the 10 to 15% returns in residential property over the next 3 to 4 years, but it will more move back to the mean, sort of 2-3% return. But we don't think that we're going to see, particularly in the urban CBD type areas, you're not going to see a correction in house prices unless there's a large change in terms of how the banks lend. Okay.
Ben, have you got something for the shopping list for reporting season or for this time of year?
Yeah, it's actually in small caps. My favourite stock is M&F Group. The multiple is quite elevated when you compare it to the rest of the market, but they're doing 25% organic growth at the moment, and they're tacking on a few small acquisitions. I think it's incredibly well run. It's under geared, and I just think a stock like that, even though it is in that small cap space where it is susceptible to some large volatility day to day, I think it can report very well and continue to do well throughout the course of this year.
Okay, great. Well, there you have it. There's a bit of a backdrop for the investing year. It's not plain sailing, and everything that worked last year might not work again this year.